Welcome back, everyone, to our Water Investor podcast. So today we'll be talking about surviving the stock market warfare, and we'll be touching on the investors' investing behavior as well. So today we are fortunate to have Mr. Ang Kok Heng, who is our Phillip Capital's Chief Investment Officer. Welcome, Mr. Ang, to our platform today.
Thank you.
I'm sure you're aware that the war between Russia and Ukraine is still ongoing at the moment, and as well as the China's zero COVID policy, and as well as the European energy crisis as well. I mean, there's so many things that's ongoing right now in the market. Will the rest of the year be continuing to be this unpredictable and volatile as well?
You see, every year there will be problems in the market, right? This time you have inflation, you have Ukraine-Russian war, you have COVID, you have U.S.-China trade conflict, etc. Right?
Yeah.
But over the years, we have other type of problems. So you are concerned about this type of volatility. I think there's no 1 year whereby we don't have any problem. But maybe this time is a bit more because the COVID has been around for so many years, and inflation also has been dragging on for more than a year.
Yeah, as you mentioned just now, inflation, right? With the inflation that's so high right now, it's also causing this possibility of recession. So we're just wondering, how is it impacting the stock market sentiments at the moment?
Of course, sentiment will be probably weak because of all this problem. But if you look at U.S. market has been holding up very well, although they got one of the worst inflation in their history. And the interest rate have been going up at a very fast pace that probably never happened before. But yet the stock market didn't go down very much. People are investing in good company, right? Good company, they were able to survive through all this type of thing, and eventually they may even come out stronger, because the weaker competitor probably may not survive. So eventually the stronger company were able to gain market shares eventually.
Yeah, but that's one side of the story. But what about the other people what about the other investors? They will think that is it risky to invest now? What is the normal or predictable investor behavior that we would expect when the market is low?
I think when you talk about market risky, etc., basically you are referring to trader, not investor. Investor normally looking for a longer term, right? Looking for a company that are strong, that are good. Temporary setback like the high inflation and etc. will not deter the long-term growth prospect of a good company. So the timing wise, I think definitely the trading is not good timing. But investment, when market comes down, that's the best time to invest. So if you're an investor, then you should buy. You're a trader, then you should wait.
Yeah, this concept is also very close to when there's sales, you see in the supermarket there's sales, people always rush to go and buy. But then we always, when it comes to the investment market or the stock market, people don't react the same way. Like when market is low or everything is going down, they tend to be afraid or scared or cautious about it, instead of buy more, that kind of thing. So why is that different in that sense?
One of the difference between the buying shares and going to a supermarket or cheap sale is that the share market is volatile, right? So as long as you don't buy at the bottom, in the process of buying, the market still coming down, you're still losing money. So when people buy it, then they regret, they should have bought later. Prices is coming down, right? But for investment, if you go for longer term, right, you buy and then if market come down further, then you should continue to buy. To do that, then you should not time the market in the sense that I put everything in one go. You should buy some, right, and wait. If the market go up, good, you can make some money. If the market come down, it means that it's cheaper now, give you better opportunity. Then you should add. That is the investment perspective. But a lot of people are coming in as a trading perspective. And they also get mixed up between trading and investment. They're not sure whether today they're buying for trading or buying for investment. For investment, you should not worry about the prices coming down. You should be worried about whether are you buying good company or not good company. For trading, then you must look at are you buying a good timing, right? Because trading means that you are going for shorter term and probably got limited capital. If you got 5,000 and then that's all you can have, then you can only do for trading maybe, because you cannot average further.
Yeah, I see the difference now between the trading and investing. But could you further explain more on why is it bad to invest in a trading perspective, or in other words, emotional investing? How do you further elaborate on that?
I think you should start with whether you want to be a trader or want to be investor. Trader, then you buy a good company, you prepare to hold. This is what investment. For trading, then you are going for short term, buy and sell, right? You hunt for short term, right? Then the type of stock also may not be the same, right? You're going for those stocks that are more volatile, then you can have better capital gain in the short period. That follow a lot, but at the same time when market recover, you can also rebound a lot. These are more for trading, right? So investors, I think very importantly is to differentiate between the two and see which side of the coin you want to be at. You want to be a trader or you want to be investor.
Can you share on why do you think it's important to manage your emotions when it comes to investing?
Of course, emotion is very important, but not easy to manage. Not many people can manage emotion, because everybody always looking at your stock and looking at the price. If you don't look at the price, then there's less emotion. But since market have a price every day, then that influence your psychologically and also influence your emotion. Unlike property market, for example, there's no prices. After I buy a house, you don't know the price. Next month or even next year, you don't know the price, so you don't have much feeling, and it will not affect your emotion. Even the price of property go down, you may not even know. But share is different, right?
Because you constantly look at it.
Yeah, you have the price, and that price affect you emotionally. You say that whether you're making money or losing money. So that is one of the main factors. But on the other hand, coming to emotion, right? I think there are techniques of how to control emotion, right? So it helps you. See, but human being is such that you have emotion, right? Whether can you control or not? There are very few people that can really control the emotion, and these are people who are really good traders. They are not very excited with the profit or loss. They are more looking at whether are they doing the right method, right strategy in terms of trading is concerned.
Can you further share on any tips to avoid investing emotionally, like for example, to study the market or get fund managers' opinion on it? Can you share more on this?
Of course, before you invest or you trade, then you must get some information, and you must also see how should you invest or should you trade, right? So you follow the so-called the plan that you wanted to do, right? So for trading, your trading plan. For investment, your investment plan. So for investment, first you look at longer term. You don't want to look at short term, right? You're looking for longer term profitability, right? Not like making 5%, 10%, you're happy, You're looking at I want to keep it for 3 years or 5 years. The time horizon is more important than the profit over shorter term, right? So you have a target. Say this stock will worth how much, right? So if the share price is far away from the target, from your so-called intrinsic value, then you buy, right? So you're aiming at the intrinsic value of the share, not so much on the quoted share price. So this is one way to comfort yourself if the share price come down, that you're buying something that is worth a lot of money, worthwhile to hold on.
Okay. So I think that's all we have today. Thank you so much, Mr. Ang, on sharing on your insights on investing behavior. So to conclude it, you just need to know yourself whether you want to go into short-term investing or long-term investing, and that will determine whether you are trading or investing. So I'll leave that for you to decide. So we'll end the session today. If you have any comments or any suggestion on topics, please leave in the comment section below. So yeah, remember, don't forget to like and subscribe to our YouTube channel, our Facebook, Instagram, and LinkedIn. That's all for today. Thank you. Bye.